Hello, hello, hello. Welcome to Money with James. So you have some spare cash. Bank's paying you pennies. What do I do? So I often get asked this question by my friends and family. I have a little extra money. I don't really know what to do. Banks aren't really paying much on the interest I have with them. Transaction accounts getting negligible, 0.1% or nothing. And interestingly, my nephew asked me this question just a few days ago. So I'm actually creating my very first video just for him. He'll hopefully be the first viewer. And I thought I would also try and do my best at least to share some of my experience with a wider audience than just my friends and family. So here I am, thereby hopefully helping improve financial education for the entire world, as I certainly think the world needs it, where house prices are incredibly expensive. The younger generation today are going to struggle to get ahead. I think it's a complete minefield and a mess out there. So I thought I would hopefully be an extra voice, having spent 30 years dedicating my life to learning about this topic. Hopefully I'll be a voice that somebody or more than just one is interested in listening to. So here I am. This question, what do I do with a little extra money, is not quite the most straightforward question to answer. There isn't really one answer for everybody. But I hope to sort of set a framework around answering it and do my best to answer it for you today. So for our example's sake, let's say you have $10,000 to invest, ready to go. Firstly, well done you for having some leftover money. And it's worth mentioning, just as a separate sort of thesis around how we should be managing our money. Generally in financial planning circles, they say you should have anywhere from 6 months up to 2 years of your living expenses in cash or cash equivalent investments, which is a very worthy goal, and hence why I'm mentioning it. But it's also a little bit ridiculous in today's day and age, because not many people that are getting out, that are probably going to be watching this video, that are trying to get ahead, are probably going to have access to that amount of money. But nonetheless, I thought I would share that idea so that at least you know you kind of want to have a certain amount of money, as much as you possibly can, as much as even 2 years, of living expenses in cash or cash equivalent. So that's a goal to work towards at some point. So anyway, back to the question at hand. The first and most important question to ask yourself is, what is your investment time frame? This question will keep coming up in all future videos, as it is paramount. It is maybe the most important question for you to determine what do you do with your money. Firstly, it basically means, when do you need to access it? You've got $10,000. Are you going to need it in the next 3 weeks to buy a car or do something, go on a holiday, whatever? Do you need it in 6 months, 5 years, 10 years? Or is it something that you're parking and hopefully building a nest egg for your future or even your next generation? Depending on your answer to this question, substantially changes the answer to the question of what do you do with it today. The second most important question is the most difficult question for people to get their head around over time. So it's worth mentioning. Will you freak out if in a month from now you only have $9,000 in your account? In other words, what is your tolerance for fluctuations in the value, otherwise known as volatility or paper losses? Unfortunately, investments don't necessarily go up in a straight line. They generally have many ups and downs on their way towards a longer term higher value. So it can be quite an emotional journey, especially when it comes to investments where you can easily just grab your phone, log on somewhere and see the value of it at any given moment, every second. Obviously, I'm coming to you today when we just had one of the biggest downturns in the stock market in many years. Japan was down 13% in one day. The entire stock market, Nikkei, was down 13%. On that day, most people, especially if you're new to this, are probably freaking out because the S&P then went on to go down 5%. It had a bit of a volatile day, but thankfully turned around during its day. So depending on which time zone you live in, you will have seen that it recovered a little bit. So then today, now Japan, Nikkei is up, I think it closed up around 11%. So you know, in one day, 13%, then 11%, net 2%. If it only moved 2% down, probably I wouldn't even mention it. But because it's such a big day, that sort of volatility, as they call it, or that swinging around in value, is really tough for most people to take. So, you know, it's one of the hardest things for you to get your head around and get a bit better at understanding. As compared to when you own your own home, you basically can't tell the value of it day to day. Does it go up and down 10% over a year? Maybe, who knows? It doesn't really matter. You don't immediately think of selling it simply because the price of your neighbor's house is 10% lower. You still live in it. You still plan to hold it for the next 10 years, etc. So the sooner you can get a bit familiar with that kind of merging those two perspectives into one. So if you're buying stocks or other investments which you can monitor the price of on a daily basis, if there's a swing, as crazy as the swing was yesterday, you know, don't panic. You know, is your investment thesis still the same? And if it is, then stay the course. Ultimately, over time, that's really where, you know, the sooner you start, the sooner you get better at it. And starting with something like $10,000 is much better than, you know, $1 million or whatever. If you end up getting to that sort of scale, you know, you need to be able to emotionally handle those movements. And starting sooner and getting better at it, the sooner the better. I've been doing the stock market for nearly 30 years, and I still feel it. Yesterday, my portfolio took a hit. You know, it still takes some thinking. Do I still feel comfortable with what investments I have? It makes you kind of reconsider things. Thankfully, I've been doing it long enough. I bought more yesterday because I thought it was completely ridiculous and overdone, but I couldn't see the future. I couldn't see today. It turned out to be a great decision. Part of that's experience, definitely. Logically, it seemed to stack up, but who knows what tomorrow brings? And unfortunately, nobody can tell. Tomorrow, we could have any number of crazy events happen, which would mean that you have another 10% downswing. That doesn't mean you don't invest today. Annoyingly, markets overreact. Yesterday was a perfect example of it. There's a very famous economic theory called the efficient market hypothesis, which all economists sort of purport when you're going to university or wherever studying economic theory. Sadly, it's not actually so efficient. The market does a poor job of assimilating information and pricing it fairly. Yesterday was a perfect example. This roller coaster of portfolio value is the hardest part for most people to get better at understanding. So I'm talking to my loved nephew today, and I'm telling him, don't worry as it goes up and down, stay the course. And that goes for everybody listening. Many just can't take the stress of this volatility, and friends and family that have come along on the journey over my time doing this, they've asked questions, they've tried, they've gone through a financial crisis, they went through the dot-com, you know, they went through COVID, they went through the European crisis, any number of the events which have been big swings that haven't bounced back in a day, but maybe they've taken weeks or months or even years. Many of them cancel out. They don't come back. They feel that pain of the paper loss. They then realize that loss by closing out their position, and then they think it's all too hard and they never come back again. The key to remember is even if it's gone down on paper, so your account is showing a lower number, you haven't actually lost that value yet until you close the position. So if your investment thesis or if your plan or if your idea of why you invested in that company hasn't really changed, then nothing's changed. If nothing material has actually changed outside of some chaos in the market, which is causing everything to go down, then maybe stay the course. Ignore the fluctuations. If you'd done that in .com, if you'd done that in the financial crisis, if you'd done that in COVID, if you'd done that in any of the other crises, even yesterday, you would largely be better off today, depending on the exact stock you were in. If you're in a portfolio, you would be better off today. Markets at all-time highs, you know, approximately, certainly relative to all of those crises. So, you know, you need to sort of factor that in when you're starting this journey. Perhaps don't look at it every minute or day or even week. You know, you wouldn't do that for your home. You're not going to immediately sell out if it moved 5%. So make your careful and thoughtful investment decisions. Don't watch them so intensely. Obviously, this is easier said than done, but this is the kind of voice that you need to build in your head as you go on this journey, that you make your decisions, you stick with them, you relax, you go along with the journey. As I say, I've been doing this for 30 years and I still have to remind myself of that. Yesterday was excessive. By the end of the market, the US market, you could see that things had turned around, thankfully, but nothing is certain, and you really must take some risk to get some reward. So it's kind of part of the package. Anyway, that was a bit more than I was planning to mention on that point, but I do think it's a relevant topic and worth mentioning. So back to the topic at hand. Where do you put $10,000? I've categorized three main areas, four in total, but three main areas. You've got cash-based investments, so money market accounts, term deposits, certificates of deposits, high yield savings accounts at the bank. This is if you have a very low risk tolerance, you don't want those fluctuations, or you have a very short time horizon, few weeks, few months, maybe even as much as 6 months, let's say. So you want to be able to access that money. You don't really want to have break fees. You don't really want to have a bad market turn and then have to close out and realize those losses that happened at that time. Therefore, you probably want something safe. Option two is similar, an interest-bearing investment, but it's called bonds. Bonds are a silly finance term for loans. Loans to governments, loans to companies or corporates, and effectively all they are is where you and me or other big companies can effectively become the bank to these people that need money. So we as individuals can lend to the US government or the UK government or the Australian government, any government in the world. We can lend them money and we get a yield, we get an interest-based return on that. So we effectively become the mortgage maker, the bank. We can do that to corporates, Coca-Cola, Microsoft, any of these massive companies in the world. The greater the risk of the company or the less safe the country or company, the greater the yield generally, or also the time frame, depending on how long you lend them the money for. That whole term of lending under that framework is considered bonds or fixed income investments. They can be a little bit risky depending on which you invest into, but largely in the world of money, they consider the US government investing in their bonds is the safest investment in the world. So, worth considering doing. It's a little bit more complicated than I've summarized today, but it's worth mentioning, hence option two. Option three, the one that we all know about, the one that's going to probably take the most amount of time on this channel, and that's the stock market or real estate or any of the growth-based assets. Individual stocks, Microsoft, Google, anything that you've heard of, or ETFs, which is sort of baskets of stocks, or real estate, whether it's a house, an apartment block, a commercial, an office building, a shopping center, or a listed fund which owns real estate and then allows you to invest in it. Obviously, all of these things come under the same sort of umbrella of growth-based assets, where generally the return you're getting is growth in the value of the asset over time and a bit less so on the income. Obviously, some of them have income, dividends, and rent from the real estate trusts and whatever. But back to today's sort of simple question of $10,000, you're not really going to be buying too many houses outside of Italy and other European cities that are selling houses for $1. They're derelict houses in these small cities for such small numbers at the moment. Fascinating idea. Going back to our main categories, we had option one, cash-based, we had option two, bonds or loans, and we had option three, growth-based things like the stock market. Then there's option four, the niche category. Peer-to-peer lending is a funny new one which has come up, which is effectively the same as bonds, where you lend to you and me, smaller investors or small companies via platforms, online apps and whatever, and you can invest to average investors and other people. You get much higher risk, but you get much higher return. Not something I would recommend for most people. Robo-Advisors, another relatively new platform, again via apps and websites. You put your money in there, you answer a bunch of questions to tell them your risk profile, your risk tolerance, and then an algorithm or AI generated sort of platform goes and invests that money in stocks or wherever to give you the yield that's proportionate to the risk tolerance that you've submitted. Another fun one is cryptocurrencies, Bitcoin, Ethereum, and the thousands of others that have been created. They don't really have their place in the world yet, in my opinion. Obviously fun for almost gambling or dabbling in on the side. The use case is definitely growing, but it's not something that I would recommend short term for most people. It's too high risk. It's not really the safe sort of way. I think the three categories that I've created are where you want to put it. And the final one, obviously cryptocurrency is considered digital gold. Then you have actual gold or precious metals, silver and otherwise. Again, considered a bit of a hedge towards investing. They say Gold is where you should put your money when you're worried about inflation. Most people have been fairly worried about inflation since the financial crisis, when the world started printing copious amounts of money, i.e., quantitative easing in the official terms, but basically creating money out of nothing. Sadly, gold did not really stand up to that test so well, at least in my opinion. What did was assets, especially recently. Assets, so option 3, stocks, real estate, etc., have exploded in value. That's because inflation has affected them the most, as opposed to gold, which has a bit more of a complicated use case. So nonetheless, still worth knowing about and considering. But in my opinion, your first 3 categories are the 3 categories that we should be highly considering in the short term, especially for something like $10,000. So anyway, I hope I've created some ideas for you to consider. Perhaps I've just overwhelmed you with choices that mostly don't make sense to you, but hopefully more videos to come, and I'll be able to explain more of what I've said today. So let me summarize. More likely the answer will be different for everyone. But a common answer for most people, I would say, is to put some in one category, let's say a quarter or half in the cash, right? Safer option as you're starting out, and then perhaps put half or 3/4 in stocks. And an easier way to do stocks when you're first starting is ETFs. So you can simply buy the S&P 500, which is the big, broad US stock market, or any of whichever country and currency you're denominated in. Each country has a major index, and that index has a major ETF or many ETFs which track that index. I will explain that at some further date. But effectively, you could just put $5,000 in the S&P 500. SPY, is State Street's major ETF, which tracks the S&P, and then leave it, and that will track 500 companies. You get a lot of the diversification and sort of smoothing out of returns based on, as opposed to buying just one company. And then you get a portion, depending how much you've put aside in your cash-based account, that you have access to that money if you need it short term. Obviously, you can still sell your other one and get the money out if it's gone up or down. It doesn't matter so much in that sense. If you really need access to it, it's there, is what I'm more referencing. But as I say, back to the beginning of the video, you need to decide your time frame, you need to decide your risk tolerance, but most important of all, you need to just jump in and do something. Most people, as they start this journey and they hear all of this mumbo jumbo that I've just started to share, their head explodes, they get overwhelmed. Many people freeze, they put their heads in the sand, and they get overwhelmed by these topics. The whole reason for me creating this channel is I want to empower you to not do that, to start to learn, to take charge of your financial future, or at least do that less and less over time. Gain more confidence and knowledge and experience. It's a totally normal feeling to get overwhelmed with these topics. You've worked hard for those money, that 10,000 or whatever you have. It's taken time, it's taken effort, it's taken saving, it's taken giving up, coffees and experiences and things so that you have that little nest egg. It's hard fought. I get it. It means so much to all of us. But that proves my point. That proves that I think the wisest long-term strategy is for us to each take some power and control back over our financial education, over our financial decisions, over our financial future. So that means doing the best you can. That means listening to this channel. Hopefully I can fill you with interesting things to learn. Other channels, books like I've got behind me, I started reading those when I was about 13. And it never stops. Learning, trying, doing the best you can. And that's all we can really do. So thanks so much for watching to the end of my first video. Hopefully it wasn't too boring, a little bit interesting, jumped around a little bit, many topics. I'll try and get better at sharing my experience while you try and get better at understanding these, often overly complicated world of money. It's really not that complicated. It does take a bit of effort, a bit of patience, but hopefully I can help you with that. Anyway, I look forward to seeing you all again very soon. Thanks so much for joining.